Assalamu alaikum friends. Welcome to day 2 of your Audit and Assurance Revision Crash Course. Today's topic is rules and regulations. So starting with, what are the topics that we are going to cover today are international and UK standard setting and regulation. Why should we have an audit? Who can be or who may be or may not act as an auditor? How are auditors appointed and removed? And auditors' rights and duties. So, starting with international and UK standard setting and regulation. What are they? What are some standards that we need? One is IFAC, that is International Federation of Accountants. What is it? They are a group of accountancy bodies, for example, ACCA. They have no legal standing in a member's country. Okay. Then we have IAASB, International Audit and Assurance Standard Board. These are the standards that you need to know. Okay, this can come as a your multiple choice questions in section A. So you need to know this. It is a subsidiary of IFAC. They set international standards on auditing. So IAASB is the one who sets the standards on auditing, international standards on auditing, known as ISA. In the EU, all audits must be carried out in accordance with international standards on auditing for the periods on or after 1st of January 2005. Now, ISS, what is it? ISS, you can adopt and you can change it according to your own country, right? You can even set your own standards if it is necessary. Remember, if it's necessary, you can change it. Otherwise, you don't. You go by the ISAs. Next, if you are doing any modifications, okay, it should reflect the legislation relating to that, the companies in that country that the client is based. But this can be different from that in other jurisdictions. Okay, the ISAs and all. If you are making any modifications, there will be differences. Then local law overrides ISAs. If you have some local law relating to audit, that will be given first preference over ISAs. Remember that. Next, we are moving towards why to have an audit. As you all know that businesses nowadays, they have owner somewhere else and someone else is managing, right? The owners are no longer managing the company. They are not involved in day-to-day business, right? Shareholders does not even know what's happening in the company. It is the managers who run the company on behalf of the shareholders. You have seen that earlier the businesses were like we have sole trader, where the owner manages the company, he runs the company, he knows what's happening in day to day, right? Then it came to partnerships, and then it came to limited companies. In the limited companies, what happened? Shareholders and managers, they are separate from each other. Their duties are separate. Managers are the one who runs the company. They know what's happening in the company, but the shareholders, on the other hand, they just have the shares in the company. They just own it, but they don't know what's happening in day to day. So because of that, so many fraud and crimes are happening, taking place. One good example is Enron. Take Enron's case. What happened to Arthur and Edison? That's a very good example because the huge businesses, the huge companies, they are collapsing due to incorrect financial statements, due to fraud happening. And all of this needs to be checked by whom? An auditor. Therefore, we need this audit, right? Distinction between owners and business. Main reason why audit came into place is because owners and managers are separate, hence the limited liability status. Third, we need a legal framework because of this separation. To protect whom? To protect the owner from the manager. And also to protect the public at large, because public, they rely on that financial statements. So it's very easy for the owners to take advantage of what? Limited liability, because they know their liabilities are limited. That's why the audit comes into the picture. Okay, especially the large companies, the limited companies, by law they have to make financial statements and they need to publish it to the public depends on this, they rely on their financial statements. So if there is an error or material misstatement, how can anyone know? There needs to be some check, right? For example, you are giving an exam, right? Why do you think teachers are there? To have a check on you. Because you will be copying, you will be cheating, and you will be passing. That's the reason they check on you. So auditor's role is the same. They check. They are like supervisor. They check what's happening. They supervise what's happening. They monitor. Their role is that role in the company. Okay, so they provide an independent check. That's why we need an audit in a company. Hence, the profession of auditor comes into the picture. And now, most countries, almost any country you see, there'll be an auditor in the company auditing the financial statements. Okay, but small companies are exempted from this because having an auditor is very costly. Okay, the fees of auditors are way too much. That's the reason why we are studying this audit, right? Because in the future you want to be an auditor and earn a high amount of fees, reputation, status. All this comes at a cost, and small businesses, they cannot afford this cost of having an auditor. And because they are small, owners can manage the company, right? They don't need huge amount of people who managers to run it. So they don't have a principal agency issue. They know what's happening. So therefore they don't need an auditor. But big companies, they by law they need an auditor. According to the law states that you need an auditor after you reach a certain size, especially limited liability company. Those are not exempted. Now we are moving on. Who may or who may not act as an auditor? This is very important. Not everyone can act as an auditor. There are there are scope who can and who cannot. For example, first of all, we'll go to the list who may act as an auditor. Number one, there are two. One is individual and the other ones are firm. So when it comes to individuals, who can act as an auditor? He should be a member of a recognized supervisory body. It could be anything. ACCA is one example. CPA, SEMA. There are so many other bodies, right? But he should be a member of recognized. It should be recognized and supervisory body. One example is ACCA. If you have studied ACCA, you can act as an auditor. And that means it's not just one, another condition needs to be met. That is, it should be allowed by the rules of that body to be an auditor. According to the rule of the ACCA, it should allow you to be an auditor. Or someone directly authorized by the state, the law says that he should be an auditor. When it comes to firms, on the other hand, the firm should be controlled by the members of a suitably authorized supervisory body, same as individuals. Okay, should be a member of the supervisory board, or a firm authorized by the state. Now let's go to the one who cannot act as an auditor. Who are they? Employees. Okay, they excluded by law. There are two things. One is excluded by law, the other one is excluded by ethics. Excluded by laws are the ones, for example, in Britain. Okay, this is related to Britain, but it's suitable for you also if you are in any other country. An officer or director or secretary of the company, they cannot act as an auditor. For example, the employee. Any employee of a company, they cannot act as an auditor because they are working there. They have financial interest, they have self-interest in that company, and if they audit, it's like they are checking their own work. So definitely they cannot do their own work, right? Someone else has to check your work. Hence, we need an auditor that is external, that is independent, that is objective. An employee cannot be independent of what he is auditing. He cannot give an objective decision because he has a financial interest. His salary is dependent on that work he is doing. So he cannot be an auditor. A business partner or employee of the above. A business partner or employee of the above means a business partner of a director or an employee of the director or business partner of a secretary. Even they cannot be an auditor. Now, let us go to the one excluded by ethics. It is due to lack of objectivity or independence. For example, you might lack objectivity, you might lack independence. It could be due to so many reasons. Okay, these are some few reasons. First reason is close business relationships. If you have a close business relationships, the auditor has a close business relationships with the client, you cannot act as an auditor. Okay, next, personal relationships. If you have some personal relationships, for example, you are an auditor in your father's business, in your brother's company, you cannot act as an auditor because due to that personal relationships, you will not be you're not independent of your brother or your father. Long association with the client. You have stayed with the client for so long that you are not independent anymore. Whatever decision you take, you will be taking on his favor, your client's favor, because you are attached to the client because of that long association. So you may not add as an auditor. Fee dependency. What is fee dependency? You are dependent on the fee. If you are dependent on that fee, for example, they told you to do something, right? And they told you that they are going to give you fee. You're dependent on that. You cannot add because you are not independent. You're dependent on the fee. You have a self-interest. You cannot add as an auditor. And finally, non-audit services provided. If you provide non-audit services, you cannot add as an auditor. Okay. So now we are moving towards how they are appointed and how they are removed. Very important. How the auditors are appointed. In most jurisdictions, they are appointed in this ways. Okay. Number one, they are appointed by the shareholders. They themselves. Okay. Shareholders themselves appoint auditors. Directors also can appoint the auditor, but they can appoint the first auditor, okay, and fill a casual vacancy. But second time when they have to appoint, they need the members' approval in the annual general meeting. Then appointment runs from end of annual general meeting until the end of the next annual general meeting. Okay. Then we have, what about where there is no annual general meeting? Then automatic. Okay, there's an automatic annual reappointment that takes place. Annually, that same auditor will be reappointed automatically if there is no annual general meeting. But if the shareholders object that he should not be an auditor or he should not be appointed, then he cannot. Now, how the auditors are removed? Number one, majority. If the majority in the annual general meeting says that this auditor needs to be removed, if he gets a majority vote, he's removed. Law, the law says, okay, the law requires special notice to be given. Then we have resignation. The auditor, he himself resigns. Okay, but if he's resigned, then he has to submit what are the circumstances that he is resigning, that he need to submit to the members. Next, auditors' rights and duties. Very, very important. What are auditors' rights? So there are so many rights of auditors, starting with they have access to all the information, all the documents in the company. Okay, at any time. If they ask for any information from the client or from any person who is related to the client, for example, the supplier of the client, the customer of the client, they have to give him the information. They have to provide information as well as explanation also. Then receive notice and attend company meetings. They can attend company meetings. They have the right. Auditor has the right to attend. Speak at such meetings. They also can not only attend, but they can speak also. They can raise their voice also in the meetings. Then they can receive copies of any written resolutions of the company. If they are resigning, okay, they can claim an extraordinary general meeting, that is known as EGM. EGM does not happen frequently. It happens only on very special occasions when something needs to be done immediately or emergency is there. Okay, something is of very significant nature, then it is not annual general meeting. There is a meeting called as extraordinary general meeting that is held. Okay, so auditor had the right to do that on resignation. And they also require notice of circumstances that leads to the resignation. Coming to the duties, their foremost duty of auditor is to report to the member whether the financial statements are giving a true and a fair view of the company. Okay, and whether they have been properly prepared by the company or not. That's the principal duty, the most important duty of the auditor. Now, so that's it for this. We are now moving towards the exam focus. From the exam's point of view, you need to go through this from your study text, test your understanding 1 and test your understanding 2. Okay, from your chapter 1. Okay, so that's it for rules and regulations relating to audit and assurance. Next, what's there for tomorrow, day 3? That's corporate governance. So tomorrow we are going to go through corporate governance and audit committee in detail. Until then, thank you for watching, and don't forget to subscribe to my channel, like, comment, and share. Thank you.